So friends, today we are going to see all the different investment options which you can avail in 2023 so that you can grow your capital over a period of time. So this investment option is also called as asset classes in the dictionary of the financial world. And please share this video to your friends and relatives so that they can also understand what are these asset classes or investment options wherein they can put the capital, salary or business income, they can invest this capital so that they can grow this income or grow this capital over a period of time and hence making wealth for themselves. So let's see what are different investment options. When I say investment options or asset classes, obviously every asset class comes with a risk and return. Depending on the risk you take, the higher the return. So if you take a high risk, you get a better return. If you take a low risk, obviously the returns have to be low. So the first investment option which I'm going to discuss in this specific video is your cash or savings or fixed deposit investment. So these are very low risk in nature. They have a capital protection as well as they give you interest on a monthly or a quarterly basis or on a yearly basis depending on the options which you have enrolled with a specific bank or with a specific institution. So now because they are low risk, the returns also typically with respect to the high risk assets are going to also be low. So typically fixed deposit pay you interest rates of an average of about 7 to 8%. That is what you get from fixed deposit or savings account. Savings account obviously will be a little lesser than fixed deposits. And then you have money market instruments which also almost run in sync with the fixed deposit rates or slightly even better than fixed deposit rate at a point of time depending on the interest rates of the country. So that is the first option which one can avail of, the low risk option. And obviously if you're going for a low risk option, you have to go for the low risk option when you have a short term requirement. That is a requirement which you need to cater within a period of 3 months, 6 months to a year or maybe maximum 2 years. So you can't run into a risk of losing this capital or have to bear with the volatility of the market when it comes to high risk asset investment. So this is your first investment. The second asset which I'm going to discuss in this video is bonds. So bonds are slightly less riskier than other assets. Of course, it is slightly more riskier than compared to savings or fixed deposit because bonds are issued. Of course, if they are issued by the government, I agree that government backed bonds are the most safest, and the other backed bond that is backed by institutions or banks or corporation, these bonds can be more riskier compared to government bonds. However, the risk is associated with the credibility of the institution or the banks or the corporation which is issuing these bonds to the investor. And when investor buy these bonds, they get paid a coupon rate, also called as the interest rate, and these are paid semi-annual basis. Check it out on your demat account, on your brokerage account. You can check out the various bonds which are available and you can see that every bond comes at a par value and it has yield to maturity. So depending on the yield to maturity, you can invest your money. So if you invest in bonds, you can get a higher returns compared to fixed deposit or just keeping it in terms of cash into your home. So obviously when I say bonds, also you need to keep in mind the interest rates, the prevailing interest rates at that particular point in time. So if the interest rates of the country are high at that particular point of time, then the bond prices are low, hence the capital appreciation, the promise of capital appreciation is much higher, and the coupon rate which you're going to get also is going to be higher. The yield of the bond is going to be higher because the bond prices, the existing bond prices need to come down to match the high interest rate regime of the particular country. So similarly, likewise, the other reversed way, when the interest rates fall down, then the bond prices have to go up so that it matches the interest rates of the nation. So you need to play the game. You need to watch what are the interest rates of the country before you invest into bonds directly, or you can directly invest into bonds which are issued by mutual fund industries. So that is your second asset which you can invest your income. This is less riskier compared to equity, which I'm going to discuss as the third asset option. The third asset option is equity, wherein you can invest your money into the stock market. You can buy various companies and get mind-boggling returns over a long period of time. Equity is a high-risk investment option, and because of its high risk, the returns you can expect is much better even than compared to bonds or even compared to fixed deposit revenue. So now, why is it high risk, right? Because the company depends on the profits which it can make from the markets, depending on the products it sells in the market. If the products sales don't do well, then the profits of the company deteriorates, and because the profit of the company deteriorates, hence the share price also starts to fall. But nevertheless, it also depends on the perception of the all the investors playing in the market. If the perception of the investor is that the fundamentals of the company are still strong from the long-term nature, it could also just be that the share price still goes up. However, you need to be very careful while investing into equities. You always invest in equities when they are undervalued, and if they are overvalued, you keep away from equities. You go into other assets which are undervalued at that particular point of time. So that's about equities, and equities beat the low risk investment option over a period of time. The longer you keep your equity investment, more than 5 years or more than 7 years is what I'm talking about. When you invest in equities, you need to have the patience of waiting for more than 5 years to 7 years. And when you invest your money into equities, it should be to cater to that financial goal which is a long term in nature, something which you can wait for more than 7 years to meet. Okay, that is when you invest into equities. So now that I've covered equity as the third investment option, the fourth investment option is your real estate. So there are different ways of wherein you can invest into real estate. You can buy a residential land, or you can buy a residential flat. You can buy a commercial land, or you can buy a commercial flat, and the returns varies. The commercial properties gives you higher returns compared to residential. Or the third option of investing into real estate could also be, buying REIT units of REITs which are available in the stock exchanges. There are different REITs companies. There is Embassy REIT, there is Brookfield, and there are a couple of more REITs which I have made a separate video. You can go and have a watch of how you can invest in REITs, what are the benefits of investing into REITs. You can watch my separate video. I've shared the link of REIT video in the description box, so you can click on it and have a look about REIT investments. So in real estate, this is also contrary. I mean, it's not directly related to your equity investment. Depending on the performance of equity, your real estate investment doesn't directly be in sync with the performance of your equity. Hence, it's an important asset which one should have to diversify. Investment into real estate will give you a fixed income over a period of time, that is your rental income, and give you capital appreciation on the investment of real estate. So that's about real estate, and you can expect, if it is a land, you can expect a return almost in line with that of equity. You can expect almost like 13 to 15% on an average when you invest into land. When you invest into flats, you can expect almost an average of 10 to 12%, excluding your dividends, excluding your rental income. So that's about real estate. Then you have gold. Gold is your fifth investment option which you have, and the liking of gold in our nation is great. So it's a stable investment option. It is used to hedge inflation over a long duration of time. As long as the government keeps printing money, it keeps increasing the inflation rate, and the GDP of the nation keeps growing, you can expect gold to also continuously give you returns year on year, and it's a stable returns shown in a period of time. It keeps your capital protected. Obviously, you don't get stable kind of an income like a dividend or a rental income. You don't get that. But if you sell your gold, it is highly liquid and you can immediately convert into cash. So that's about gold, the fifth investment option. The sixth investment option, the last investment option which you have, is art and collectibles. Now, when you collect arts or other antique collections, this value of this antique collection which you as an investor would buy and then when you sell the other investor, it's all subjective in nature at that particular point of time. And usually when investors buy art or collectible, they keep it for a long duration of time. Sometimes could be more than 25 years as a matter of fact. Compared to that, if you invest into equities, you can get returns, within a period of 7 years or so. So you should be careful while investing into art and collectibles, what kind of arts you're collecting. And it's all subjective. When I say 25 years, it could sometimes even mean within 2 or 3 years you could encash your investment. But it is all, there is no kind of a methodology wherein you can decide what is the amount you can pay for a specific art or a collectible today, so that you can encash it for a greater value in the future. Of course, any art or collectible, because of inflation, because of all other aspects, because of the hard work gone into it, its value over a period of time needs to definitely increase. So you can bank upon arts and collectibles if you want to diversify your portfolio much further on. You have like equity, you have real estate, and then you can diversify further into arts and collectibles. So these are various investment options that one can avail of in 2023. And if you want to know more details about which investment option you can highly concentrate, it depends on which asset or which of this investment option is undervalued today. Depending on that, you can concentrate on that specific asset or that specific investment option. So you can enroll with me. I have been doing investment since 2010. And it has worked out a great deal to me. Investment into real estate, investment into equities, investment into golds also. Of course, art and collectible, I'm yet to diversify. As I get more information about investing in art and collectibles, I'm definitely going to share in this specific channel of mine. So you please like it and share it to your friends and relatives. And I hope you could get value out of this specific video. In case not, in case you want me to share more details about specific investment option, please write into a comment section and I'll be glad to make a separate video altogether about a specific investment option. See you until then.